You think your money in the bank is safe. You've been told that FDIC insurance will protect you, and for years, this assurance has been enough to put your mind at ease. But here's the truth most people don't know. There's a law that was quietly passed in 2010, under the guise of protecting taxpayers, that allows banks to take your deposits in the event of a financial crisis. Yes, your money can be taken, legally, to save the bank from collapsing. I know this sounds unbelievable, but the reality is that the money you've entrusted to the bank is not truly yours. It's the bank's money the moment you deposit it. When you deposit your funds, you're technically lending money to the bank. You become an unsecured creditor. This means that, if the bank fails, your savings could be used to cover its losses before you ever see a penny of it again. This happened before, just not in the U.S. In 2013, Cyprus experienced a banking crisis that stunned the world. Over one weekend, the government of Cyprus passed a law to seize deposits from bank accounts over a certain threshold. No warning, no permission. People woke up to find that half their life savings was gone. And it was completely legal. Now, while this was a small country, the same legal framework exists here in the U.S. with the Dodd-Frank Act. The government has already laid the groundwork to do the same thing when banks begin to collapse. And with a financial storm brewing on the horizon, 2026 could be the year that your savings are at risk. To understand what's coming, we need to rewind the clock a bit. In 2013, the world witnessed an event that would reshape the way we view our bank deposits. Cyprus, a small island nation in the Mediterranean, became the first country to openly practice a strategy that the U.S. has quietly adopted, a bail-in. The situation in Cyprus escalated quickly. The country's banks were facing insolvency after taking on too much debt and making disastrous investments. In the past, governments would have stepped in to protect depositors, using taxpayer money to bail out the banks. But in Cyprus, the government introduced a new solution. Instead of bailing out the banks with taxpayer money, they decided to take it from the people who had trusted them with their deposits. The government passed an emergency law allowing the banks to seize funds from account holders with deposits over a certain amount. Over the weekend, the nation's banks were closed, and when they reopened on Monday, account holders were greeted with a devastating surprise. Anyone who had more than 100,000 euros in the bank saw a chunk of their savings disappear. People who thought their money was safe suddenly found themselves financially crippled. While Cyprus is a small nation, the lesson here is universal. The concept of bail-ins has become a model that many governments and financial regulators have adopted worldwide. In fact, the legal groundwork for bail-ins was laid much earlier, in the aftermath of the 2008 financial crisis. In 2010, in response to the 2008 financial crisis, the U.S. government passed the Dodd-Frank Act, a sweeping piece of legislation aimed at reforming the financial system. One of the key elements of this law was the establishment of the Orderly Liquidation Authority, OLA, which created the legal foundation for bail-ins in the U.S. The Dodd-Frank Act was introduced as a way to prevent another financial meltdown like the one that occurred during the global financial crisis. The intention behind the law was clear: ensure that taxpayers would not have to foot the bill to save failed banks again. Instead, the responsibility would fall to creditors and depositors, those who had lent their money to the banks. So, how does this work? Essentially, when a bank fails under the Dodd-Frank framework, the FDIC, Federal Deposit Insurance Corporation, steps in, but not to rescue the bank with taxpayer funds. Instead, the FDIC can convert depositor funds into bank equity, essentially turning your deposits into shares of the failing bank. It sounds almost too extreme to be true, but it's all legal. Your money, once deposited into the bank, technically becomes the bank's property, and you become an unsecured creditor. This means the bank can use your money to stabilize itself in the event of a crisis. And here's the chilling part: they don't need your consent. The FDIC has the authority to implement this procedure unilaterally. While many Americans may not be aware of the U.S. bail-in framework, this concept has already been tested in real life. In another part of the world, Cyprus, in March 2013, Cyprus faced an economic crisis so severe that the country's banks were on the verge of collapse. The government's solution was to implement a bail-in, an event that stunned the world and left depositors with nothing but shock and disbelief. The situation in Cyprus was dire. With banks on the brink of insolvency due to bad loans, excessive debt, and mismanagement, the government was forced to act. Instead of a traditional bailout, where taxpayer funds would have been used to rescue the banks, they decided to take a radically different approach. They passed a law that authorized the banks to seize a portion of depositors' funds to recapitalize the financial institutions. On the fateful weekend of March 2013, the government of Cyprus announced that anyone with more than €100,000 in their account would lose 47.5% of their excess deposits. In an instant, account holders who thought their savings were safe woke up to find that half of their money was gone. The news shocked the nation. Small businesses could no longer make payroll, retirees saw their life savings disappear, and the entire economy came to a standstill. It was a stark reminder of how quickly a financial system could turn against its own people. What happened in Cyprus serves as a warning for the rest of the world. Though many believed it was an isolated incident in a small European country, the legal and financial frameworks are already in place for similar actions to be taken in other countries. The U.S. has the legal framework ready. Many Americans are under the impression that their bank deposits are fully protected, either by the FDIC or by the belief that a government bailout would step in to safeguard their money in the event of a financial collapse. However, few understand that the legal framework for bail-ins has already been established in the United States. In 2010, after the financial crisis, Congress passed the Dodd-Frank Act, which aimed to prevent another crash and protect taxpayers from being on the hook for failing banks. While the public was focused on preventing another bailout, Congress implemented a different strategy: bail-ins. This legislation allowed for the conversion of depositors' funds into equity in the event of a bank failure. What does this mean? In simple terms, if a bank fails, the deposits you have in your account could be used to restructure the bank. If the bank collapses, instead of the government stepping in with taxpayer money, the money in your account may be taken and exchanged for stock in the failing bank. Essentially, your cash deposits would become shares in a bank in crisis, leaving you with worthless stock in a bank on the verge of collapse. It's not just a theoretical scenario. The Dodd-Frank Act laid the groundwork for this process, specifically through the Orderly Liquidation Authority, OLA, which grants the FDIC the power to restructure failed banks and convert deposits into equity. This authority gives the FDIC the ability to act unilaterally, without court approval or the need for depositors' consent. You are legally considered an unsecured creditor, meaning your deposit is at risk if the bank fails. While FDIC insurance covers up to $250,000. This coverage would quickly be exhausted in the event of a large-scale financial crisis, making a bail-in the default option. In 2013, a small island nation in the Mediterranean called Cyprus became ground zero for a financial experiment that would serve as a wake-up call for the rest of the world. Cyprus's banking system had collapsed under the weight of massive debts, and the government was in a desperate situation. Instead of bailing out the banks with taxpayer money, as was done in previous crises, they chose a far more unsettling solution: the bail-in. Over the weekend, while the public was oblivious, the Cypriot government passed a law that allowed banks to seize deposits over €100,000 to recapitalize the failing banks. On Monday morning, the customers of these banks woke up to a nightmare. If you had €200,000 in your account on Friday, by Monday you had €150,500. The government had taken nearly €50,000 from your account without your permission, and there was no way to get it back. It wasn't just the wealthy who suffered. Small businesses, retirees, and ordinary citizens saw their life savings disappear in an instant. Without warning, people lost not only their money, but also their livelihoods. And it was entirely legal. The law had been passed quietly, buried in the fine print of a few government documents, and there was nothing anyone could do about it. This was the moment when bail-ins became real, and it shocked the world. Many Cypriots thought this could never happen in their country, just as many Americans believe it's impossible for this kind of financial theft to happen here. However, what took place in Cyprus wasn't just an isolated event. The framework for bail-ins is already in place in the United States, thanks to the Dodd-Frank Act. And with the current financial pressures on banks, the risk is only growing. The Cyprus crisis wasn't a one-off. It was a blueprint for how a country can legally take your deposits in times of crisis. In the wake of the 2008 financial crisis, the Dodd-Frank Act was passed as a response to the widespread outrage over the use of taxpayer dollars to bail out failing banks. The public demanded that the government take action to prevent another situation where billion-dollar bailouts were paid at the expense of ordinary taxpayers. On the surface, the act promised to safeguard the financial system and protect the people. But buried deep within, it was a provision that most Americans have never heard of: the Orderly Liquidation Authority. This authority gave the Federal Deposit Insurance Corporation, FDIC, the power to step in and restructure failing banks without the need for taxpayer funds. On paper, this sounded great. Instead of burdening the public with bailouts, the law proposed that banks' creditors, including depositors, would bear the brunt of the damage. Deposits, once thought of as a safety net, would become a liability in times of financial collapse. In essence, the Dodd-Frank Act allowed for the conversion of deposits into equity, meaning that if a bank were to fail, your money wouldn't just vanish into thin air. Instead, it would be turned into shares of the bank's stock, which, in a collapse, would likely be worthless. And the most troubling part? This could happen without your consent, without a court order, and without any public announcement beforehand. This is the stark reality of what could happen during a future financial crisis. The bail-in is not a hypothetical threat. It's already in the law. And while the FDIC offers some protection through insurance for accounts under $250,000, it's a shallow cushion. In a systemic crisis where multiple large banks fail at once, the FDIC fund could be exhausted almost immediately. The only remaining option? Bail-ins, where your savings are seized and used to rescue the failing bank. Now that you understand the gravity of the situation, the question becomes, what can you do to protect yourself? First, don't wait for the crisis to hit. As the saying goes, the best time to plant a tree was 20 years ago. The second best time is now. The time to act is today. You might not have 20 years to prepare, but you have the power to make sure you're protected well before the storm hits. Step 1. Audit your bank accounts. The first thing you need to do is take a good hard look at your bank accounts. Write down how much money you have sitting in each one. If you have more than $250,000 in a single bank, you're at risk. The FDIC might cover smaller amounts, but beyond that, you're unprotected. Split your money across multiple banks to ensure you're below the limit in each one. Step 2. Move money to treasury bills or money market funds. Do you know where your money is right now? Consider moving a portion of it out of the banking system and into treasury bills. These are backed by the full faith and credit of the U.S. government, making them a far safer option in times of crisis. You can easily purchase them through Treasury Direct. If you haven't already, open an account and start allocating some of your funds into these instruments. Step 3. Buy precious metals. Physical gold and silver hold their value during times of economic uncertainty. Unlike paper money, these assets can't be printed away. They are valuable outside the financial system and provide a hedge against the devaluation of your dollar. You don't have to go all in, but allocating 10–20% of your wealth into precious metals can act as an insurance policy when the dollar starts losing its grip. Step 4. Diversify internationally. if you haven't already. It's time to open international accounts. Banks in countries like Switzerland, Singapore, or Norway offer more stability than those in the U.S. And while it might sound extreme, keeping part of your wealth outside the U.S. in a stronger financial system could be your lifeline if the U.S. economy collapses. Step 5. Protect your business. If you own a business, take the necessary steps to protect operating funds. Keep only essential amounts in your business accounts and move the rest to safer assets. Whether it's treasury bills or money market funds, make sure your company is not at risk of losing its funds in the event of a bank failure. The time to act is now. The $3 trillion exodus is just the beginning, and the writing is already on the wall. Don't wait for the mainstream media to wake up. Don't wait for another bank run, for another crisis. Protect your wealth today, not tomorrow. If this information opened your eyes to the dangers ahead, please share it. Send it to family and friends. Let them know what's really happening behind the scenes. The more people who are aware, the better prepared we'll all be. Don't forget to subscribe and stay tuned for more updates. Together, we can navigate through these uncertain times. Take action now, before it's too late.